Hello all, and welcome to Stochastic Calculus for Finance. This is Chapter 1, the Binomial nor Arbitrage Pricing Model. So first in this section 1.1, we're going to talk about the one-period binomial model. But first, why study the binomial asset model? Well, it is very important to understand because it can help us understand arbitrage pricing theory, and it can also help us understand probability. But in this first section, our goal is to focus on arbitrage pricing. So what is this one-period binomial model? Well, it's very simple. So today, let's assume we have a stock, and we said the stock price is S0 today. Then the stock price tomorrow is decided by a coin flip. Head, and the stock price will go up to US0. And if we get a tail, the stock price will go down to DS0. We also need to introduce the concept of interest rate R. And all that means is that if you invest $1 today at the bank, it will grow tomorrow to 1 plus R dollar. Very simple. And conversely, we can also think about it this way. If you have a debt of $1 today, then tomorrow with interest rate, our debt will grow to the initial amount of debt we had, plus some change, which is due to interest rates. Very simple. Now that we have the general setup, we can try to understand now what the concept of no arbitrage pricing is. But first, let's talk about what is arbitrage itself. Arbitrage simply means that there is no free money in the market. This is a very important requirement for many of the models of financial markets that we are going to study here. Assuming that markets are efficient, if we build a model and found out that in our model there is free money for all, then of course that could not be used in practice. Even if in reality there might be temporal arbitrage opportunities, but they are bound to disappear as people trade on it. Turns out that in our current setup, there is no arbitrage opportunity, aka free money in the market, when the following relationship holds between D, R, and U. Here is a very quick intuition as to why this works. So first, let's look at this first part, where D is less than. If you assume that D is less than 0, all right. So that is actually this part here. Then we're saying that basically, okay, let's say 0 is greater than D, so that is D is less than 0. Then we're saying like D is negative, right? So we're saying like if there is a coin toss and we get a tail, the stock price can go down to D times S0. S0, the stock price today is positive, D is negative, so the whole sum is negative. So we're saying that the stock price can go negative. And of course, that doesn't make any sense, right? If the stock price goes down, it can go to 0. The company goes bankrupt or whatever, but it can never go below 0. That's nonsense. So that's why like 0 greater than D is not a possibility. So we need to have this part. Now let's look at the second part of the equation. D is less than 1 plus R. Well, suppose D is greater than 1 plus R. What is the meaning of this really? So what we're saying is that the stock price, even if the stock price goes goes down by D, by the factor D, it will still grow faster than money at the bank, right? So what we can do here is today we can borrow S0, right? And if we borrow S0 today, that means that tomorrow we need to pay back S0 1 plus R, right? We need to pay this. And now today also, with the money we borrowed, right, we can buy the stock for S0. So we buy the stock for S0. That means tomorrow, even in the worst case, if the stock price goes down, if we get a tail, so the stock price would be worth in the worst case scenario, D as 0, right? But we said that D is greater than 1 plus R, right? We said like this D guy is greater than this 1 plus R. So what that means is like this side is greater. So that means what we can do tomorrow, we can just take the stock, right, that we bought earlier, we sell it, get D as 0, and with that money, we pay back our debt, 1 plus R, and we'll be left with the difference, free money for our pocket. So that is why this side of the equation has to hold. Now let's assume that we look at this side, right? Why this has to hold? Well, if we say 1 plus R is greater than U, then that means like even in the best case scenario where the stock price goes up, it will go up by an amount less than money at the bank. So of course, in this case, you don't want to hold the stock, right? You want the money at the bank. So you can do some arbitrage by first shorting the stock. So today, what we do is short the stock. And when you short the stock today, that means tomorrow you will probably have to cover your short, buy back the stock and return it to who you borrowed it from. So tomorrow, we will need to buy back the stock. And the worst case thing that can happen is the stock price goes up. So we'll have to buy it like at a higher price. So let's say like we look at the worst case that will happen, like the stock price goes up to U as 0. So when we short the stock, we get as 0. So what we can do with that money is invest at the bank. So invest at the bank. And what we're investing is at as 0. So tomorrow, the money in our bank account will grow to S0, the initial amount that we invested, time 1 plus R, the interest rate, right? And now, since we're assuming that this 1 plus R is larger than this U, right? So that means that the money we have in our bank account tomorrow will be larger than the money that we need to spend to buy the stock in the worst case scenario, right? So that means that we can pocket the difference here and make free money. We didn't take any risk. We didn't have any investment at the beginning, right? We just, the money that we get from shorting the stock, we took it and invested at the bank. And we make money at the end no matter what. So this has to hold, otherwise there is also another arbitrage opportunity. So very loosely, we have shown like an intuition as to why this relationship has to hold for no arbitrage to happen. Okay, great. So now let's move on. So where are we going with all of this? Well, with our initial setup, now that we talked about the one period binomial model, and then we talked about the concept of interest rates, then we're really ready to understand arbitrage pricing theory. It links to risk neutral pricing. And for this, we'll start with a very simple example of a European call option. So here's like the initial basic setup we have. So we assume that the stock price today, S0, is equal to 4. U is the amount by which the stock price can go up tomorrow. So we can say tomorrow the stock price can double. Or D here, the stock price can be slashed in half. And our interest rate is 0.25. And the strike price on our call option is 5. So this is it. So I have built the tree here for us to see what I'm talking about. So the stock price today is at 0. Tomorrow it can go up to 8 if there is a head, right? And notice this 8 is just the 4 times 2. There's the tail here. The stock price, if it goes down, the price can be divided by half, and that's really it. So what is the fundamental question of option pricing? So we need to find the price today. What should be the price of the option today, given the information we have? So we call V0 the price of the option that we do not know today, but we do know the price of the option or its value when there is a head, right? Because the strike price is 5, and the stock price will be 8. So 8 minus 5 is just 3. And if the stock price goes down to 2, then the call option obviously is out of the money, right? So then, given this information you have, how do we find the correct price for this option? This is where arbitrage pricing comes into play. The arbitrage pricing approach is to replicate the option by trading the stock and the money market, which is just investing or borrowing from the bank. If there is really no arbitrage, then the price of the option should be equal to the value of the replicating portfolio. And we'll go very into more details about what this means. So let's say we start with an initial wealth of x0, and we say our initial wealth, the money we started with, is 1.2. Then with this initial wealth, we go and buy 0.5 shares of the stock. And of course, since the stock price is 4, this is going to cost us a total of 2. So we start with 1.2, and we actually spend delta 0 as 0. And as you can see, we're spending more to buy the stock than our initial wealth. So that means that we have a cash position of the difference here, which is going to be 0.1. And since it's negative, that means that's a debt, right? So we have only this, and we need to spend all of this. So we go borrow the money at the bank, and the amount we borrow, our cash position will be minus 0.8. Very simple. So this is our current setup that we have. I built the trees here for like the stock price and the different values of the option, and we want to figure out the value of the option today, given the payoffs that we know already. So let's review our current portfolio. So we have like stocks. Our portfolio is made of stocks, and that's 0.5 shares of S0, that's worth 2 today. Cash or our debt, we're in debt by 0.8. And total value of our portfolio is just going to be the sum of our stock, the value of our stock, and the value of our cash position, which is negative because it's a debt. That is 1.2. Now what happens is tomorrow the stock price goes up, or aka we flip the coin and we get like a head. Then the stock price we have 0.5 share, and now the stock price is S1H, which is just 8, so that will be 4. Our cash position, we borrowed $0.8, and so this is going to grow at the interest rate R, which is 0.25 to minus 1. So note that the total value of our portfolio, if there is a head, is just going to be 4 minus 1, and that's 3. Very quickly, note how this 3 here is identical to the payoff of the option in the case where we have a head, right? So let's note that first. Then what is the value of the portfolio if we get a tail, aka the stock price goes down tomorrow? Well, we had 0.5 shares of the stock, and the stock price now went down to 2. So 0.5 times 2, that's just simply 1. And our cash position, we had like a debt of 0.8, and that debt grows to minus 1. And when we sum these two to find the total value of our portfolio, that's 0. And note again here how the value of our portfolio that we derived by trading the stock and the money market is equal to the value of the option at expiration as well. Very interesting. So because of this, then we're saying that the value of the option has to be 1.2, which is simply the value of our portfolio, of our replicating portfolio at time 0. And this has to be true, right? Because whether the stock price goes up or the stock price goes down, the value of the option is equal to the value of the replicating portfolio. So that means at time 0 today, the value of the replicating portfolio should be equal to the value of the option here, 1.2. So, and that is like if there is no arbitrage. If the value of the option is anything different than this 1.2, then there will be an arbitrage opportunity. For example, imagine that the option is selling for 1.3, right? Then the option is overpriced. What you want to do is sell the option, right, and get 1.3. And then with that 1.3, you hedge your position by building the replicating portfolio, right? And that's going to cost you only 1.2. And then you completely hedge, and you have the difference of 0.1 in your pocket. Similarly, if the option price is 1.1, then it is underpriced. So you want to buy that, you want to buy this option, and you want to short the replicating portfolio here, right? And when you short it, you get 1.2. You buy the option for 1.1, and you have a difference. You perfectly hedge, and you have this difference of 0.1 coming in your pocket. So because of that, the value of the portfolio and the value of the stock price have to be equal, because their payoffs are identical, whether the stock price goes up or the stock price goes down. And that is actually the essence of arbitrage pricing. So arbitrage-free pricing for general derivative. So in general, we call a derivative security any security that pays an amount V1H if the coin toss results in a head, and V1T if the coin toss results in a tail. And to determine the price of the derivatives V0 today, all we need to do is replicate it as we did previously. So let's call X0 the starting wealth used for replication, and delta 0 the number of shares we trade in a stock for this replication. All we want to do really is that the value of our portfolio tomorrow is equal to the value of the derivative security tomorrow as well, no matter what the coin toss is. So I have added the trees here. So the value of this is the value of the option today that we want to know, and we know the value of the option tomorrow, whether it's a head or tail. And we need to find the replicating portfolio such that the value of the replication portfolio tomorrow is going to be identical to the value of the option, no matter what the coin toss is. So we want essentially V1 head to be equal to X1H, and we want V1T to be equal to X1T. And once we manage to do this, then the value of the X0 that we're going to find here is going to be has to be equal to the value of the derivative security. Otherwise, there will be arbitrage opportunity. This is just exactly a slight generalization of what we just did earlier. So let's try to understand what the link to risk neutral probabilities and where these risk neutral probabilities are coming from, right? And what do they actually mean? So we actually start with an initial wealth of X0. And what we do with our initial wealth is that we take some amount of money and we buy delta 0 share of the stock. And of course, this is going to cost us this amount. We're buying delta 0 share, and each share costs S0. Very simple. And we invest our remaining wealth in the bank, right? In the money market. So we had this much X0, and we spent this much to buy the stock. So at the end, we're left with this amount. That's all that means. Then our portfolio value today is X0, right? Which is just equal to the value of our stock holdings plus the value in our cash position, right? And as you can see, this matched our initial wealth. Our wealth didn't disappear. We simply took some money and bought the stock. That's all there is to it. So tomorrow, what will happen to the value of our portfolio? Well, it will grow to this amount. And this is a very scary formula, and I think people think stochastic calculus is hard because there are like a lot of algebras to be done. But if you look into it actually and think about the meaning, is very simple. So this first part here, all this means is a stock holding value, right? We had delta 0 stock at the beginning, and the stock price now next day went to S1. So the value of our stock holding is just the number of shares that we had multiplied by the value of one share of the stock. Very simple. And what this side means is it's simply just a value of our cash position, right? So at the beginning we had this much wealth, and we spent this much to buy the stock. So our cash position left was X0 minus delta 0 S0, and this grows at 1 plus R, the interest rate prevalent in the money market, and that's all there is to it. So that's what this part means, right? And here is just like some little algebra. So for example, this part here is just coming from taking this X0 and multiplying by this 1 plus R. That's where that is coming from. And this S1 minus 1 plus s0 plus r is just basically coming. So we take this one, right? You see we have delta 0 that we factor out, and we have this side also that is multiplied, given that we factored out this one. And that's all there is to it. Very simple little algebra. So let's remember what we want. We want to find x0 and delta x0 such that we have replicated the value of our derivative security, right? So essentially this is just what we mean. And that's just boils down to this relationship, right? And all we did here is we took this, for example, this s1h, and we replaced it by its value. Very simple stuff. And this thing again is coming from just this formula here that we showed earlier, right? How our portfolio would grow tomorrow, given the stock price and interest rate prevalent in the money market. Very simple stuff again. So this is what we have, right? So let's think about this. Okay, so we want to solve for delta 0. So one way to solve for delta 0, So one way to solve for delta 0 is basically we can just subtract this, right? Subtract this first part by this first part. And when we do that, what we get is this goes to 0, right? And then yeah, that goes to 0. And then this thing also will go to 0, right? Because we're subtracting two values that are equal here. So at the end, when we're doing this subtraction, all we get is delta 0 s1h minus delta 0 s1t is equal to v1h minus v1t. Again, this is nothing extraordinary, right? We just took the subtraction. We just subtracting these two equations from each other. And that means we get delta 0 factor s1h minus s1t is equal to v1h minus v1t. Right? Very simple stuff. And then we can divide both sides by this amount, and then we have solved for delta 0, right? Because delta 0 is just now v1h minus v1t divided by s1h minus s1t, right? So we found like one of the unknowns already. This is what we want. We want to find the number of shares that we need to trade. So this is going to be the number of shares that we need to trade in for the replicating portfolio. So very simple stuff. So remember that relationship that I just showed you for delta 0. And also what we can do now, we need to find the initial wealth, right? So we can do that by dividing both sides by 1 plus r, and we will get this relationship, right? So that just like we divide both sides by 1 plus r, so these guys disappear, this thing disappear, we divide this by 1 plus r now, same here, and we divide all this guy by 1 plus r as well. Very simple stuff. Just a little algebra. We have then two equation with two unknowns, right? Delta 0 and x1. And actually already showed you how we can easily solve for this one. That's very good. So now we need to focus on understanding how we can actually find this one. And this is actually where the concept of reasonable probability are going to show up first. So what we're going to do here now is we can multiply we can multiply the first equation by this guy. We multiply the second equation by this guy, right? And that's what we do here. And then we sum them up. And when we do that, we get this complicated looking formula. But again, just a little bit of algebra. When we take these two and we sum them up, we just get this equation here. And now what we want, actually, it would be very nice to solve if somehow all this guy goes to 0, right? So this is what we have, and ideally we would love to have this thing goes to 0, because it will make things the algebra a lot easier to work with. So that's exactly what we do. We choose p tilde, hence q tilde, such that this relationship hold. And again, if this relationship holds, that simply means that this thing is equal to 0, right? So by doing that, so we just replace basically this first part here by S0 as to make algebra easier. And that is when we find actually a relationship for x0 now, right? So you find that x0 is going to be equal to this. So we had the relationship for delta 0 and we have a relationship for x0. So we're pretty much done. So we just need to find like what are like this magical p tilde and this magical q tilde, such that we can easily just zero out this stuff. So then we need to do some algebra to solve for this p tilde, right? And by doing some algebra, we can find this p tilde and this q tilde is just equal to this. And it's very easy to find this relationship. So it's coming from here actually. So we're saying that S0 is equal to 1 divided by 1 plus R, right? Time p tilde S1H plus q tilde S1T, right? Just doing some algebra now. So that's S0 1 plus R is equal to p tilde S1H plus q tilde S1T. Right? So now we know this S1H is just the price, it's just US0, and this is just like DS0. So we can replace that. So S0 1 plus R is equal to p tilde US0 plus, actually I can just replace this q tilde by 1 minus p tilde, right? That's by definition. And then this S1T is nothing but D S0. Very simple thing. So now we can divide this whole thing by S0. So we have this will disappear, this will disappear, and this will disappear. So we'll have 1 plus R is equal to p tilde U plus D minus p tilde D. Very simple. And we simply want to find this p tilde, so we can factor them out. 1 plus R equal to p tilde U minus D, right, and plus D. Hence we have p tilde is equal to 1 plus R, and this D goes to the other side of the equation, minus D divided by U minus D. And as you can see, this is just this guy here. That's where it's coming from. And then you can just do the same thing to find the q tilde. So 1 minus p tilde is just equal to q tilde. I'll let you do the boring algebra, and you will find that q tilde is also equal to this. And that's pretty much it. Nothing really extraordinary. And again, I showed you this earlier. By just subtracting those two equations, you can find this relationship for delta x0. So we just find x0 and delta 0 we need to replicate the derivative. By arbitrage pricing theory, we know that the value of the replicating portfolio, right, should be equal to the value of the option that we're trying to find. So we can essentially write just this guy, right? This x0 is equal to v0. And as we shown previously by solving for x0, we found that x0 is nothing but this guy here. And also note that p tilde and q tilde actually sum up to 1, all right? They are positive due to like this condition. And we also see, so we can think of them as some type of probabilities, right? But they are not actually real probability. That's very important to understand. They are just like, p tilde is just like a number that was very nice. That we got to help us solve the algebra, because we just wanted this part here to be 0. Because once this part is 0, we can find this relationship for x0 in terms of things that we know very easily. So that's all this p tilde is and this q tilde are, right? They are just like very nice number that can help us solve some algebra. Sorry about that. Well, okay, so P tilde and Q tilde are just very nice number to help us solve some algebra. They are not real probability. Very important to understand. But they are calling risk neutral probability because from this relationship, we can see that the price of the stock today, S0, right, is just the discounted expected value of the stock tomorrow, right? Because we can think these are the probabilities and these are like the two cases, the two events that can happen. Discounted stock price tomorrow, and then we say that that's equal to S0, and that's the relationship that we needed so that like that equation that inside the part of the equation that was inside the parenthesis will go to 0 and help us do the algebra very easily. So essentially, we're saying that the stock price is earning the interest rate R, the risk-free rate R, as if the investor don't really care about the extra risk involved in equities, aka as if the investors are risk neutral. That's why we call risk neutral. And it's conveniently picked P tilde and Q tilde give us a nice relationship for V0, and we call this the risk neutral probability formula, right? Because we can see that now we have this very nice formula when we have when we use this P tilde and Q tilde, because we're just saying like basically that the price of the option today is just the expected value of the payoffs of the option discounted at the risk-free rate. And that's where the risk neutral probability is coming from. So let's look into summary very quickly what we just did. So we introduced the one-period binomial model, all right? And then we introduced arbitrage pricing by replication. To find the price of a derivative security, all we need to do is replicate it by trading in a stock and the money market. And once we can replicate the derivative security perfectly, then the value of that derivative security today is equal to the value of our portfolio. And we also show that like there are like these nice numbers P tilde and Q tilde that we can derive, and that will help us really like make the algebra easier. And it turns out that those P tilde and Q tilde sum up to 1. They are positive. We can think of them about some probabilities, and those probabilities are called risk neutral. And thank you very much. That's pretty much it. See you next time where we'll be talking about the multi-period binomial asset pricing.